Welcome back, Focus Learners. Today we're mapping out something genuinely fascinating, what I like to call the absolute life cycle of wealth. We're going to use the UK ACCA taxation rules as our lens here to watch how wealth is actually built, taxed, shielded, and, eventually passed on. We're tracking the whole journey, literally from the birth of corporate profits right through to personal legacy and the final estate. It's a brilliantly logical system once you see it laid out. So let's get ready to master the mechanics. Okay, let's dive right into this roadmap. We're breaking this pretty complex tax algorithm down into 5 logical steps. We'll hit corporate tax rates, look at managing tax losses, pivot to inheritance tax allowances, check out lifetime gifts, and finally, compute the death estate. Let's go.
All right, Part 1, Corporate Tax Rates and Rules. This is all about taxing the living, breathing business.
Now, we've all heard Benjamin Franklin's famous line, right? In this world, nothing is certain except death and taxes. Well, in today's explainer, we're actually covering both. It's kind of the ultimate double feature: corporate taxes in life and death taxes at the very end.
So let's look at how these corporate tax bands map out. It's actually quite clean. If a company's profits are at or under £50,000, they just pay the small profits rate of 19%. Simple. On the flip side, if profits hit £250,000 or more, they're hit with the main rate, a flat 25%. And what about that middle ground? Well, that's exactly where marginal relief steps in to sort of gradually bridge the gap between the two.
But wait, before a company ever calculates that final tax bill, they have some massive shields available to them. I really want to highlight the sheer scale of capital allowances here. Look at these numbers. Businesses can claim a 100% deduction through what's called full expensing for new plant and machinery, or they can use the annual investment allowance, the AIA, which literally shields up to £1 million of qualifying expenditure. It's an absolute game changer for reducing taxable profits before those tax rates even kick in.
So if you take away just one thing from this first stage, lock in this one-line summary. Corporation tax is 19% under $50,000, 25% over $250,000, with marginal relief smoothing out the middle. That's the core of it. But hey, what happens when the business takes a hit? That brings us to Part 2, managing corporate tax losses. Let's talk about shielding that wealth.
Think of a trading loss like a safety valve for the company. That loss can actually travel in a few different directions to save some cash. If a company takes a hit, it can push that loss backwards against total profits of the previous 12 months for a quick tax refund, or it can carry it forwards indefinitely to offset future trading profits. It can even move it sideways, surrendering the loss to another company, provided they're in a 75% group structure.
Now lean in for a second, because this is where people constantly trip up on the exam. The standard rule: you carry a loss back 1 year. But, and this is a huge but, there is a special exception. If a business is completely ceasing to trade, creating what we call a terminal loss, only then can it be carried back 3 years against trading profits. Do not, I repeat, do not apply that 3-year rule to an ongoing business.
All right, moving on to Part 3, inheritance tax, scope, and allowances. We're pivoting from the corporate entity to the legacy of the individual. Because business wealth ultimately ends up in human hands, right? So let's define your baseline shields against inheritance tax, or IHT. First, every single individual gets a nil rate band, the NRB. That allows you to pass on £325,000, completely tax-free. And on top of that, you've got the residence nil rate band, the RNRB, giving you an extra £175,000 of tax-free allowance, specifically for passing your main home to your descendants. When you combine these, you start to see just how powerful this is. An individual can effectively shield a total of £500,000 of their personal wealth from the taxman before a single penny of IHT is paid. $500,000. And if you're married, spouses can actually transfer their unused allowances to each other, which means a couple can potentially shield up to £1 million.
But watch out, here's another massive exam trap. That extra £175,000 RNRB, it's strictly conditional. You only get it if the main residence is being left to direct descendants. We're talking children or grandchildren. You absolutely cannot claim it if you're leaving the house to, say, a sibling or a best friend.
Now, before death, folks often pass on wealth. That brings us to Part 4, lifetime gifts and transfers.
The taxman is definitely keeping an eye on your gifts too, and the system builds this really strict dichotomy between 2 types of gifts. First up, PEATs, potentially exempt transfers. These are gifts given directly to other humans. There's no upfront tax, and if you survive for 7 years after handing over the gift, boom, completely tax-free.
On the flip side, we have CLTs, chargeable lifetime transfers. These are typically gifts made into trusts. Now, because trusts aren't people and, well, they don't die, the taxman swoops in for an immediate 20% tax hit on anything over your nil rate band.
So what happens if you make a gift and, unfortunately, don't survive that magical 7-year window? Well, Taper Relief to the rescue. It dramatically drops your tax burden the longer you survive. Make a gift and pass away within 3 years? The gift is hit with 100% of the full inheritance tax. But look how it tapers off. By years 6 to 7, you're only paying 20% of the tax. It really does pay to outlive your gifts.
And finally, Part 5, Computing the Death Estate, the final calculation.
This is the end of the life cycle where all these rules finally converge. I want you to treat this computation exactly like a recipe. Follow these 5 steps systematically and you won't miss a beat. Step 1, value everything you own at probate value. Step 2, deduct the debts, funeral costs, and anything left to a spouse for charity because those are totally exempt. Step 3, pull back in any of those PEATs and CLTs you made within the last 7 years. Step 4, apply your NRB and RNRB shields. And Step 5, whatever is left standing is your taxable estate, and that gets hit at a flat rate of 40%.
Lock this one-line summary into your brain. It's the ultimate formula for the death estate. Your estate minus exemptions minus your NRB and RNRB allowances equals the taxable amount. Multiply that by 40%, and you've got the final tax bill. Simple as that.
So, we've traveled from the 19% corporate tax of a living business through the strategic carrying of losses right up to the 40% final tax on an estate. I'll leave you with this thought. Mastering these rules isn't just about passing an ACCA exam, it's really about understanding how wealth is shielded in the real world. So, will you leave your wealth to the taxman, or will you use this structure to plan ahead? Think about it. Keep this roadmap handy, and I'll catch you in the next explainer.